Welcome students to today's lesson. Today, we are diving into an important topic, the general ledger, posting, and the format of a ledger account. This is a critical part of the accounting process, and understanding it will give you the foundation to track financial transactions and prepare financial reports effectively. Before we begin, please open your books to Chapter 3 and turn to the section on the general ledger. This is where we'll be starting today. Make sure you follow along closely as we'll be covering 1. What the general ledger is and why it's important. 2. How transactions are posted to the ledger. 3. The proper format of a ledger account and how to use it. Take your time as we go through this step by step. Grab your notebooks for examples and don't hesitate to jot down questions for the discussion at the end. Let's get started. When you begin studying accounting, one of the key terms you will encounter is the general ledger. Let's break it down in simple terms so it's easy to understand. What is the general ledger? The general ledger is the heart of a business's accounting system. It's like a giant database that contains all the financial information about a business. This includes details about the business's assets, liabilities, capital, income, and expenses. Every financial transaction that the business undertakes is recorded in the general ledger through individual accounts called ledger accounts. Each ledger account is created for a specific type of transaction or activity. For example, one account might track cash transactions, cash account. Another might record sales revenue, sales account. A separate account would track rent expenses, rent account. Every account has a unique purpose or name, and in computerized systems, it also gets an identity or code to make it easy to manage. Where did the term ledger come from? The term ledger dates back to the days when businesses recorded their financial transactions manually in large physical books called ledgers. Each page was reserved for a specific account, and accountants would write entries in them by hand. Although accounting is now computerized, the term ledger is still used. But instead of physical books, all transactions are recorded electronically using accounting software. Why is the general ledger important? The general ledger is crucial because it organizes and summarizes all financial activity of a business in one place. Without it, a business wouldn't be able to understand its financial position. How much cash does the business have? How much does it owe to suppliers? How much profit has it made? 2. Prepare financial statements. Information from the general ledger is used to create key financial reports like the balance sheet, income statement, and cash flow statement. 3. Keep track of transactions. Every dollar that comes in or goes out is logged in the general ledger, ensuring no detail is overlooked. How does the general ledger work? The general ledger follows the double-entry bookkeeping principle. For every transaction, there are always 2 entries, a debit in one account, a credit in another account. This ensures that the accounting equation, assets equals liabilities plus equity, always stays in balance. For example, if the business sells goods for cash, the cash account increases, a debit, and the sales account also increases, a credit. If the business pays rent, the rent expense account increases, a debit, while the cash account decreases, a credit. What does the general ledger include? The general ledger is made up of many different ledger accounts, each tracking a specific type of financial activity. These accounts are grouped into 5 main categories. 1. Assets. Things the business owns, like cash, inventory, buildings, or equipment. Example: cash, accounts receivable, machinery. 2. Liabilities. Money the business owes to others, like loans or unpaid bills. Example: accounts payable, bank loan. 3. Equity. The owner's interest in the business. Example: owner's capital, retained earnings. 4. Income. Money the business earns from selling goods or services. Example: sales revenue, service revenue. 5. Expenses. Costs the business incurs to run its operations. Example: rent, utilities, wages. How is the general ledger used in computerized systems? In a computerized accounting system, the general ledger acts as the foundation for recording all transactions. Instead of writing transactions in books, businesses input the details of a transaction into accounting software, which automatically updates the correct ledger accounts. For instance, if a business buys office supplies for $50, the software will update the office supplies expense account, a debit, and the cash account, a credit, in the general ledger. This makes the process more efficient, accurate, and less time-consuming compared to manual bookkeeping. In simple terms, you can think of the general ledger as the big picture of a business's financial world. It organizes and categorizes every dollar the business spends, earns, borrows, or owns. Whether it's paying rent, receiving money from customers, or buying inventory, the general ledger ensures everything is properly recorded. By mastering how the general ledger works, you'll have a solid foundation for understanding accounting and preparing financial statements. It's a skill every accountant needs to succeed. What is posting in accounting? Posting is an essential step in accounting where transactions are transferred, or posted, from the journal to the ledger accounts in the general ledger. Think of the journal as the place where transactions are first recorded in detail, and the ledger as the summary of those transactions organized into specific accounts. For example, if a business pays for rent, the transaction will first be recorded in the journal. The same transaction is then posted to the rent and rates account in the ledger. Why is posting important? Posting ensures that all financial information is properly categorized so the business can understand its financial position. By posting transactions to the general ledger, a business can 1. Summarize its financial data into specific categories, e.g. expenses, income, assets. 2. Prepare financial reports like the income statement or balance sheet. 3. Track the balances of individual accounts to see how much the business owes, owns, or earns. Understanding the chart in the attachment. The chart in the attachment lists examples of ledger accounts that you might find in a business's general ledger. Each account is categorized based on the type of financial information it represents. Non-current assets. Long-term assets like machinery and motor vehicles. Current assets. Short-term assets like cash and inventory that are expected to be used or converted into cash within a year. Current liabilities. Short-term obligations like accounts payable or overdrafts. Non-current liabilities. Long-term obligations like loans that won't be fully paid within the year. Capital. The owner's investment in the business. Expenses. Costs the business incurs to operate like wages, rent, or advertising. Income. Money the business earns from its activities, such as sales revenue. Let's go through each account listed in the chart and explain which category it belongs to. Non-current assets, long-term assets. 1. Plant and machinery at cost. Refers to equipment or machinery the business owns and uses for a long time. Recorded as a non-current asset because it provides value over several years. 2. Motor vehicles at cost. Refers to cars, vans, or trucks purchased by the business. Also a non-current asset for the same reason as machinery. Capital, owner's equity. Proprietor's capital. The money or assets the owner invests in the business. Classified under capital because it represents the owner's interest in the business. Current assets, short-term assets. 4. Inventory, raw materials. Refers to materials the business uses to create its products. A current asset because raw materials are converted into goods and sold within the year. 5. Inventory, finished goods, completed products ready for sale. A current asset for the same reason as raw materials. 6. Trade receivables, money owed to the business by customers who bought goods or services on credit. A current asset because it's expected to be collected within a year. Current liabilities, short-term obligations. 7. Trade payables, money the business owes to suppliers for goods or services bought on credit. Classified as a current liability because it's usually paid within a short period. Expenses, costs to run the business. 8. Wages and salaries, payments made to employees for their work. An expense because it's part of the business's operating costs. 9. Rent and rates, costs for renting office or shop space and paying local property taxes. Also an expense related to the business's daily operations. 10. Advertising expenses, money spent on promoting the business to attract customers, another example of an expense. 11. Bank charges, fees paid to the bank for account services like processing transactions or overdrafts, classified as an expense. 12. Motor expenses, costs for running business vehicles like fuel or repairs, recorded as an expense. 13. Telephone expenses, costs for phone services used in the business. Revenue from sales or services. 14. Sales, revenue earned from selling goods or services, recorded under income because it increases the business's earnings. Cash refers to physical money or money in the business's bank account. A current asset because it's immediately available for use. 16. Bank overdraft, when the business withdraws more money from its bank account than it has available. A current liability because the business must repay the bank soon. 17. Bank loan, money borrowed from a bank that is repaid over time. Classified as a non-current liability if repayment extends beyond 1 year. In summary, posting means transferring transactions from the journal to the ledger. The chart categorizes each type of ledger account, helping us understand where specific transactions should be recorded. Knowing the difference between assets, liabilities, income, expenses, and capital ensures accurate bookkeeping. By mastering these concepts, you'll be ready to record and summarize transactions properly in the general ledger. The format of a ledger account can be thought of as resembling the shape of the letter T, which is why it is sometimes referred to as a T account. This structure is used to record financial transactions systematically, with clear divisions for debits and credits. Let's break down the format step by step, using the example provided in the image. Key elements of the ledger account format. 1. Name of the account. At the very top of the ledger, you'll find the top name of the account. This specifies which account the ledger belongs to. For instance, in the example, the account is titled Advertising Expenses. Every transaction recorded in this account will relate to advertising expenses only. 2. Two sides of the account. The ledger account is split into two sides. Left-hand side, debit side. This side is used to record debit entries related to the account. Right-hand side, credit side. This side is used to record credit entries related to the account. Each transaction will be entered on either the debit or credit side, depending on its nature, as per the rules of double-entry bookkeeping. 3. Columns for each entry. Each side of the account, debit and credit, has specific columns to organize the transaction details. Date column. This shows the date of the transaction. For example, in the image, the date is recorded as 15 April. Narrative column. This provides a short description of the transaction, explaining what it relates to. For example, in the image, the description says JFK Agency for quarter to 31st of March. Reference column. This records a reference number or code linking the transaction back to its source document, like an invoice or receipt. For example, the reference is PL 348. Amount column. This shows the monetary value of the transaction. For instance, the amount of $2,500 is recorded on the debit side. Summary of the ledger account format. At the top, write the name of the account, e.g., advertising expenses. The left-hand side is the debit side, and the right-hand side is the credit side. Each side has clear columns for date, to record when the transaction occurred. Narrative, a brief description of the transaction. Reference, linking to supporting documents. Amount, the monetary value being recorded. This format ensures transactions are properly organized and easy to reference when preparing financial reports. Understanding this format is essential because it is the foundation for recording transactions into the general ledger, whether manually or using a computerized accounting system. Students, we have already discussed many of these fundamental concepts in chapters 1 and 2, such as assets, liabilities, income, expenses, and the principles of double-entry bookkeeping. If you need a refresher or want to revisit those topics, please check out the links provided in the description below. This will help you connect the dots as we dive deeper into today's lesson. Thank you, students, for watching today's lesson. We've covered some essential concepts about the general ledger, posting, and the format of a ledger account. I hope it's now much clearer how these pieces come together in the accounting process. In our next lesson, we're going to take things a step further and see how transactions are practically posted to the general ledger. This will give you hands-on insight into how the system works in real-life scenarios. Make sure you're ready because this will be an exciting step in your journey to mastering accounting. Don't forget to like the video, subscribe to the channel, and share it with others who might benefit. See you in the next lesson, and have a great day ahead.